What's up, everybody? It's Friday, November 1st. How's everybody doing? So we had the October job number today. The non-farm payrolls were up by 12,000. They were looking for 114,000. I saw forecasts as high as 180,000, but it was 12,000. Now, the Labor Department, they put up a message on their website saying that the data collected was affected by the hurricanes. We had Hurricane Helene, Hurricane Milton, so that's understandable. However, both the September and the August reports were revised lower. Actually, August was revised a lot lower by like 80,000. And September, remember we had that big number like 254,000 that freaked everybody out? That was revised down, I think, by 30,000 or something like that. So I'm not surprised, as I've been predicting or forecasting, that we're going to see a slowdown in economic activity based on, we had the one Fed rate cut. I've been telling you guys about the decline year over year now that I'm seeing in interest income transfers. Very small. All right, but we're going to get another rate cut next week. Next week's the election, folks. I mean, I already voted. I don't know how many of you voted. Tuesday's the election. We'll see what happens, all right? I mean, right now, I think there's a quote-unquote election trade going on. It's being spoken about, and it seems plausible to me, like especially when I look at what's going on in the bond market, which has been, I have to be honest, has been a frustrating trade so far for me because I'm long treasuries. I've been recommending long treasuries, and they just keep going down. And, we have some, there's some story in this. I mean, number one, probably the drop in interest rates in the lead up to the September 18th rate cut, it probably got ahead of itself, okay? Because I think the 10-year yield went all the way down to like, I don't know, was it like 3.5 or 370 or something like that, 360? Now it's all the way up to 440. And even though the Fed did cut by 50 basis points, right now, what are we? We're at 4.75 to 5 on the Fed funds rate. And so having a 10-year at 440 is probably normal, even when you consider the fact that the market is still pricing in at least one more rate cut after the November rate cut. They're pricing in one in December. That'll take it down to 4.25 to 4.5. And there's even a January thing going on. It kind of fluctuates day to day with how the market's trading. But, this morning it was, it looked like another 25 basis point rate cut in January. By the afternoon, it wasn't there anymore. It kind of disappeared. So let's call it 4 to 4.25. Or 4.25 to 4.5, and then we don't know after that. So it's kind of normal for 10-year yields to back up to this level, okay? But I think this is the high level threshold, to be honest, because like I've been saying, this one rate cut has already made an impact on the drop in interest income transfers. We're going to get another rate cut next week, and that's only going to, expand this decline in interest income transfers year over year. And like I said, leading spending flows are not much above last year, okay? It's not like we're having a big, huge increase on top of last year. I mean, we're basically up. If you do like if I adjust for a calendar quirk or calendar issue at the start of the fiscal year 2024, we're only up like 25 billion over last year. So it won't take very much in terms of interest income transfer reductions to wipe out that spending increase. And again, I've been saying this every single video, that we're only growing at 2.8%. And so, like, that's with a massive amount of interest income transfers, over $1 trillion. So, I mean, any little drop in that, I hate repeating myself every day, but I mean, repetition is how we learn. And it's kind of like the only new element in the picture right now is the election. I mean, that still has yet to be decided. It looks like Trump is going to win. There's all kinds of speculation flying around as to what his economic policy is going to be. We heard a lot about tariffs. We saw Elon Musk at the rally in New York talk about massive spending cuts. Trump himself talks about tax cuts. The Trump tax cut that he put through, what was it, in 2017 or something, that expires next year. So that will have to either be extended, or that's going to be a major source of fiscal drag. I've been talking to you guys about the smallest increase in Social Security and those cost of living adjustments coming up in January, only a 2.5% increase. That's the smallest increase in 4 years. So you're not going to have this big tsunami of new spending. I mean, we had it this year. We were up this year over, well over 100 billion over the previous year, over 2023. So, we got to wait for the election. Let's get through that. I think a lot of this trade, particularly the interest markets, the bond markets, they're fixated on this inflation prediction, or whatever you want to call it, that a Trump presidency is going to be inflationary because of the tariffs. Tariffs are a one-time deal, folks. The price goes up. Inflation is a continual rise in prices. A one-time adjustment in relative prices, that's not inflation, okay? That's not to say it's a comfortable thing. I'm not saying it is. But inflation is a continual rise in prices, not a one-time adjustment. And then there's other factors to consider with these tariffs. These tariffs are like a tax, or they are a tax, in fact. Either consumers have to pay more, or the money, that money is siphoned off. It goes to the Treasury, which could, they could say, hey, look, we're reducing the size of the budget deficit because of the tariffs, so let's keep it that way. So, I mean, there's more to consider than just that one-off price increase of the tariffs. I don't think it's going to work out to be inflationary at all. I think they have this wrong. I think this bond market sell-off, I mean, I'm convinced of this, that this is a wrong interpretation, that we will see in the coming year, I would say in the coming 2 years, okay? Because I mentioned the other day that these cycles, at the minimum, they endure for 2 years at the minimum, because they pivot off of political cycles. Political cycles are what determine policy, all right? That's why it's called political policy. So every 2 years is the midterm elections, the congressional elections. Every 4 years we get a presidential election. So, I mean, I think that for the next 2 years, and I'm going to go on record right now and say this, just like I tell you guys, like well in advance of what is going to happen based on flows, etc. And right now, I think that the next 2 years will be very positive for bonds. I think it'll be less positive for stocks and risk assets. I think it'll be much less positive for gold, okay? Gold literally cracks me up right now. I mean, it's had nobody was talking about gold except for myself back in March 2022. In fact, they were selling it because of the Fed rate hikes. Remember, the Fed was just starting out with its rate increases, and everybody was like, oh, that's bearish for gold, you have to sell it. I did videos about this at the time. I said it was the smallest short position that producers had in, like, at the time, I think it was something like 8 years or 10 years. It was a tiny, minuscule short hedge. And that told you right there that gold's going higher. Nobody really paid attention until kind of recently. And now it's like, it's blowing up all over the news. But I'm telling you, slower economic growth is not going to be bullish for gold. And, you know, it's one of those things, again, where I've said to you guys many times, like, we're going to come back and revisit this point. You know, we're revisiting right now the things I said 6 months ago about the rate cuts going to siphon off interest income, and that's actually happening right now. That is happening. Slowdown in economic activity. Okay, you could say the unemployment report was due to the hurricanes, but again, they revised down September. They revised down August. All of these things that I told, and this is just it's just in the very early stages of all these trends. Again, we only had one rate cut. Okay? You can't expect that off of one rate cut, we're going to have this gargantuan shift in conditions. I mean, these things take time. I said to a friend of mine today in an email, I feel kind of like one of these hurricane forecasters at the National Hurricane Center, where I'm way early in my forecast or my predictions, because I see these conditions coming together. The things I look at are not the typical things that economists, the mainstream economists and market analysts or whatever, it's not the things that they look at. Okay, first of all, none of them are really into MMT, and the MMT academics, well, that's what they do, academics. They don't do trading. So I feel like, how these weather guys, they'll get all excited about a cluster of thunder showers just coming off the west coast of Africa. And they're already thinking, hey, this could be something. There's conditions in place that could help to develop this into a tropical cyclone. Low pressure, the temperature of the ocean, all this kind of stuff. So I'm here doing the same thing for you guys. I'm saying I see this stuff like way out in advance. And I'm saying conditions are conducive to this thing developing into a serious, drag on the economy. So, but I'm seeing this like just like I saw the upturn in the stock market and the economy with the rate hikes, back in 2022. And also in 2023, when it was already becoming pretty evident, but not a lot of people were paying attention. In fact, they were aligned in the opposite direction. You see what I'm saying? So that's kind of like how I see it. I see it before everybody else. It's the things I focus on that, not because necessarily I'm any kind of genius. I focus on the things that create the conditions for the economy. Okay, it's like the weather people focus on the things that create the conditions for a hurricane to form. It's a good analogy. I think it's a very good analogy. Anyway, that's it for today, folks. Please like and subscribe. Don't forget to go to my website, pitbulleconomics.com. Sign up for a 30-day free trial at MMT Trader. I will see you maybe tomorrow. I don't know. All right. Have a good weekend. If not, bye.